All right, everyone, what's going on? I'm gonna wait a second here to get everyone in. While people are joining, before I forget, please smash the like button on this video so more people on YouTube will see it. Don't forget to subscribe to the channel, and don't forget that I write a daily letter to over 50,000 investors. I basically cover business, technology, finance, and Bitcoin. You can subscribe at pompletter.com. All right, people are starting to trickle in here. So if you want to get more of this stuff, go subscribe at pompletter.com, smash the like button, subscribe to the channel, and let's kick this thing off. The big news, 52 million Americans have now lost their job in the last 4.5 months. Obviously, that is an unfathomable number. There's a whole host of different reasons as to why 52 million of people have lost their jobs, but it essentially breaks down to there's a global pandemic that led to a government-mandated shutdown of the economy. And when that occurred, small businesses and large businesses alike couldn't support keeping those employees. Their revenue basically went to zero, right, in many cases. And so essentially what happened is the U.S. government stepped in, and they have something that I call bridge the gap stimulus. So the whole idea was there was a very abrupt disruption to the U.S. economy. And that was through that government mandated shutdown. And their idea was, hey, this is going to last for 3 to 6 months. And so if we can step in with monetary stimulus and fiscal stimulus, and we can basically pump up the economy, we can put money in the hands of the people who are going to be hurt. We can do everything we can to kind of prop up that economic data. We only have to do it for 3 to 6 months. And then those programs can basically end. And by the time that those programs are ending, the economy will have been turned back on and kind of recovered, and we'll be off to the races again. So you can kind of think of this as a inverted drop, right? Or kind of a V, where it drops down. And then the belief was that you were going to get that V-shaped recovery, and the stimulus would merely bridge the gap, right? And kind of keep people living the same life, not suffering from that economic drop. Now, the problem is that many of those monetary stimulus, efforts in that package are now running out. So we're kind of at the 3 to 6 month range. And as those programs expire, it's very clear that the economy has not recovered. And so there's been $2.4 trillion of monetary stimulus so far that's been presented. In that includes everything like the Paycheck Protection Program, which was hundreds of billions of dollars lent directly to small businesses. The idea there was it's a low-cost loan in the worst case scenario. In the best case scenario, if you don't fire any of your employees and you don't dock their pay, you then don't have to pay it back. So it's a forgivable loan if you kind of follow all the rules. There's also a $600 weekly beefing up of unemployment insurance. So if you applied for unemployment insurance, you basically got what unemployment traditionally would pay you plus an additional $600. That ends this week coming up. And so July 31st is when that'll end. The PPP loans, those expire at the end of September, where then businesses can go ahead and they can actually start to fire employees without getting docked and have to be forced to pay back that money. So a lot of these programs are rolling off here kind of at the end of next week into the end of September, mainly because the government thought that this would be over, but it's not. And so now we've got kind of this really weird situation where Democrats have put forward a $3 trillion stimulus package, right? If you go back and remember what I said in March, right? All the way back in March, I said it's going to take $5+ trillion for them to kind of get through this. There's no way it's only going to be $1, $2, $3 trillion. So we've already done $2.4 trillion. The Democrats have a $3 trillion package that they put forward. Republicans don't like it. Republicans have kind of gone back to the drawing board. They're trying to keep it around $1 trillion, but reports are when they unveil that package in the early part of this coming week, it's going to look something like $1.5 to $2 trillion. Now, as part of that package, there's two key things that seem to be coming down the pipe. The first is there will be more unemployment relief. So you'll continue to apply for that unemployment insurance. There's 52 million Americans who have done that for the first time ever in the last 4.5 months. But that unemployment will not come with $600. It looks like the Republican plan is going to be somewhere more in the $300 to $400 range. So they're really trying to get to about 70% of what you were getting paid at your job, can they get that to you through unemployment insurance, both with the traditional allocation or amounts, but also with the federal beefing up or kind of that additional capital. And so if it goes from, kind of $600 a week to $300 or $400, it's still some relief, but it's obviously not the $600 that's going to expire. The second thing is that they're going to put more money into the PPP program so small businesses can continue to apply for that. Now, what we are starting to see is there are many companies who have started to lay people off, right? I think it's one of the largest oil companies in the United States. They've proposed plans that they're going to lay off like 20 or 30,000 people, if I remember correctly. You also see the airlines all saying, 20, 30,000 people that they are kind of alerting, saying, hey, look, we are going to do mass layoffs kind of in the fall. And so you should go ahead and quit your job now or take kind of unpaid leave or go find another job. And so it just feels like all of that bridge the gap stimulus, they didn't bridge the gap. It came up short because the economy hasn't recovered. The coronavirus, whether you believe the numbers or you don't, it's very obvious that there hasn't been a reopening of the economy because of the coronavirus. And so that's something to continue to pay attention to. I do not believe that they're going to get a deal done by the end of this upcoming week. It's a lot to ask. And if they were to get it done, if the Republican proposal is $1.5 trillion at the beginning of the week, do not be surprised if it creeps to $2.5 to $3 trillion by the end of the week. Kind of there's almost this balance between the faster you want to get a deal done, the more money that will get packed into it. And really that's because it's easier to cave on things. And if you're going to cave on something, you're likely to cave on adding things rather than caving on taking them out. And so we saw that previously in that first bill. The original proposal was like $1 trillion. It ended up being $2 trillion. Right. And so don't be surprised if kind of a $1.5 trillion proposal ends up turning into $2.5 to $3 trillion. And as this is all going on, everyone's looking around saying, wait a second, there's 52 million Americans who lost their job in the last 4.5 months. There's all sorts of stimulus packages getting, announced and executed. Why is everyone getting rich? How is that happening? How is the top 50% of Americans getting rich? We're seeing the stock market explode. We're seeing housing, all sorts of residential home sales explode. And it's because there's a manipulation of the economy, right? They're stuffing liquidity into the market. If you look at in the housing market, for example, the 30-year fixed rate mortgage hit an average across the country 2.87% this past week. So 2.87% 30-year fixed rate mortgage. Well, that is almost 100 basis points lower than where it was a year ago. And so when you look at that number, there's cheap capital available. Of course, people are going to refinance. Of course, people are going to leverage that cheap capital to go buy homes. And so it's just manipulation. Yes, we are in a recession, but they've done a bunch of things in order to provide cheap capital so that there's still some sort of economic activity happening, right? There's all these anecdotes all over the internet where people are putting their homes up for sale and they're getting 4, 5, 6, 10 full price offers, sometimes all cash, sometimes higher than full price. The median home prices have gone up in the United States this year, right? Which is just crazy to think about during a recession. And then obviously the stock market is just exploding. Now, here's what's really interesting about the stock market. So this week we have Amazon, Apple, McDonald's, Starbucks, a number of pharmaceuticals like Merck and Eli Lilly, I think Alphabet, right? All of them are going to report their numbers. We're also going to get the Q2 GDP number this week coming up. And so these are absolutely essential data points to understand really what has happened. And so we've seen two things occur. In the S&P 500, 40% of businesses, the average loss in revenue is 40% so far. So out of the companies that have reported, the average loss in revenue or drop in revenue has been 40%. Yet 80% of the companies that have reported have beat Wall Street's expectations. So you get this really weird thing where everyone knows the companies are going to make less in money. But if revenue dropped 40%, stocks should be tanking. Except for the fact that Wall Street was actually expecting worse numbers. And so the numbers are positive in light of Wall Street's expectations. Now, this just goes to show once again that Wall Street analysts, they do the best they can, right? Some of them are incredibly intelligent. It's really hard to do this stuff, and they're usually wrong. And so when you get 40% on average loss in revenue, but that is better than the expectation of Wall Street, you get stock prices going up. You get a bunch of liquidity getting injected into the market, stock prices go up. And so this is all being manipulated in various ways so that you continue to see a stock market that's bounced, 50+% off the bottom. The NASDAQ has hit all-time highs. If you look at the S&P, it's down just a couple of percent year to date. And so this is an artificial stock market, right? There's no way that you're telling me that a stock price is higher today than it was before the pandemic, but they're making 40% less revenue. How does that make sense? And then when you look at just a macro economy level, 35% drop in GDP is expected. 35% drop in GDP for Q2. If that number comes out and it's actually only 30%, don't be surprised if there's a positive reaction. It means, we thought it was going to be really, really bad, but it wasn't as bad as we thought. And therefore people get excited and stock market go up. So it all goes back to, what are you anchoring on? What are you comparing these data points to? And usually it's on estimations from analysts or expectations. Well, who put them in charge, right? And that's ultimately the problem, is people end up looking at the short-term price movements based on how did this come in based on analyst expectations, rather than what is the holistic picture of the economy. If you said to somebody, there is going to be an average 40% drop in revenue for S&P 500 companies, there's going to be a 35% in Q2 GDP this year, the beginning of January, and the stock market is going to hit an all-time high, people would have laughed at you. There's no way they would have thought of that, right? If they said that there was going to be a global recession, but yet home prices were going to go up, personal savings rate was going to go up, personal income rate was going to go up, the average mortgage 30-year fixed rate was going to go down, nobody would believe this stuff, right? And again, it's because the Federal Reserve and the US government looked at 2008, 2009, and they said, what was the playbook? How do we intervene in this market and artificially inflate it so that we can bridge the gap? How do we actually prevent or mitigate damage until the economy recovers? Well, as we know, that there's going to be a day of reckoning. And that day of reckoning, one of two things happens. Either they are able to bridge the gap, they can continue to put trillions of dollars into the economy and basically hold over or bridge that gap until the economic data recovers and we get back to a fully functioning economy with true velocity of money and kind of capital sloshing around in a more organic way. And then they can stop with all the monetary stimulus. Or what's going to happen is that they're going to run out of bullets, right? At some point, you just can't keep printing trillions and trillions and trillions of dollars, and the economy won't have recovered. And so all of these artificially inflated asset prices are going to have to drop to meet the reality on the ground of the economic situation. Now, when that happens is anyone's guess. Obviously, if they do not come up with a stimulus package kind of this coming week and the week after, then you're going to have these monetary stimulus packages that were introduced back in March. They're going to start to end, and you're going to get that day of reckoning much sooner. If you get this stimulus package, which I believe will get passed, and again, I think it's going to be somewhere in the $2 to $3 trillion range, which will put us over $5 trillion total. If that occurs, you're basically just kicking the can down the road. You're continuing to inflate this artificial asset prices. And so we get in a really, really weird world where you're going to have to eventually pay for your sins. And one of the sins that we are committing right now is we are printing trillions of dollars. And so we're going to pay for that three different ways. The first way that we're going to pay for it is at some point the asset prices that are inflated, eventually they pop or they drop. And there's all sorts of economic damage that occurs to investors who bought into these artificially inflated asset prices. The second way that we pay for it is there's actually going to be incredible damage created by, we are propping up businesses in the private sector that should shut down. There's a lot of businesses that are bad businesses, right? That if the free market was able to operate, those businesses would get wiped out. They would go, and the entrepreneurs and the investors would lose money, but then we would get a reallocation of resources and they would end up in the hands of better run businesses. So the free market's not being allowed to operate right now. And so it's basically, if you go across the board and look at a lot of the businesses that are being propped up, they're not good businesses. And if they're not good businesses, then you don't allow the free market to clear out the bad businesses, to allow those resources to then get reallocated in a better business model or in the hands of a better operator entrepreneur. So what occurs now is that's the second way that we're going to see damage, is eventually those businesses are going to end up going under, right? You're just prolonging the inevitable. And then the third is the bottom 50% of Americans are going to get their wealth and their savings absolutely ravaged here. And if you think about what ends up happening, the wealth inequality gap is not a bug of the system. It is a feature. And it is because when you print money in an inflationary system, people who own assets, stocks, real estate, gold, Bitcoin, art, whatever type of asset, the price of those assets goes up and the value of the dollar goes down, right? Peter Schiff, I saw him tweet I think it was today or yesterday. I thought it was a really good point. He said between 1790 and 1971, the price of gold basically oscillated between $19 and $20 an ounce. Over 200 years, it literally was about $1 difference between the price of gold. All of a sudden, in 1971 to today, the price of gold has topped $1,900. That's not because gold got more valuable. It's because the dollar is being devalued. If you look at the stock market since 1971, if you price it in dollars, it looks like a directional 45-degree angle up and to the right. If you price that same stock market in gold, all of a sudden, it's basically flat. The stock market has not gained more value. It's the dollar that's being devalued. So that is how investors who own assets, quote unquote, make money. It's because it will take more dollars to buy that asset in the future rather than less dollars, right? So they are acquiring US dollar value. But the people, the bottom 50% of Americans who do not hold any assets, right? They have cash, they live paycheck to paycheck, and they can't come up with $400 emergency payment, right? It's about 45 to 50% of Americans own no stocks. They live paycheck to paycheck, can't come up with emergency payment of $400. Those people see their wealth, right? Their savings, although it's small, absolutely gets eroded away because the purchasing power gets eroded away. And their check that they receive every week is worth less money, although it's the same dollar amount. So they're getting paid $12 a week, right? Or $12 an hour. And that $12 an hour ends up being the same $12 an hour it was last year and next year. But yet $12 an hour actually bought you more goods and services last year than it buys you this year. And this year it'll buy you more goods and services than it'll buy you next year. So you're actually making less and less money, although your paycheck has the same number on it. And so we are going to have this day of reckoning. You cannot print trillions and trillions and trillions of dollars without any sort of economic damage. And so the things to watch are there's going to be a Fed meeting this upcoming week. I do not see in any world them moving interest rates up. If anything, they may go down into negative territory. That's a super religious topic. There's a lot of people for all kinds of different reasons that would fight that. So my guess is that it stays at 0%. Last time, Jay Powell said, we haven't even thought about thinking about raising rates. So to me, there is going to be throughout all of 2020 and into 2021, we're going to stay at a zero rate environment and maybe possibly go into negative territory. So I don't think we'll see that. I do think you'll see a lot of commentary, thoughts and ideas around the monetary stimulus, because that is the only lever that they have left. Is they're going to have to continue to hit us with as much of the quote unquote drug of monetary stimulus to keep the economy high, right? Use the example in the past of the economy is basically a drug addict, right? It's a crack addict. You got to keep getting a hit to stay high. That's what the economy does. The economy will not run and cannot continue to operate in the way that we want it to without getting these shots of monetary stimulus. But the monetary stimulus continues to be bigger and bigger and bigger and bigger. And so ultimately what you're going to see is you're going to see these trillions of dollars in packages. You're going to see unemployment benefits extended. You're going to see PPP money extended. I wouldn't be surprised to see another stimulus check directly to Americans, right? There's Democrats who want kind of another $1,200. Trump has come out and said that he wants something more than $1,200. Who knows what it'll end up being, but you'll get another payment directly to Americans. And then on top of all of that, what you're going to get is you're going to get earnings reports coming this week. So will the tech companies actually outperform, right? Will you see Amazon's revenue explode because everyone's sitting at home ordering things online? Will you see Apple? Are more and more people buying stuff? Facebook, if all of a sudden time on site and users exploded, will you actually see that translate to additional ad revenue, right? We saw Twitter have one of their best growth quarters ever. And so I think that the technology companies continue to outperform in this sector. It makes sense. Everyone's sitting at home, moving to a digital world. Of course, the digital companies will do very well. And then all of kind of the non-digital companies or non-digitally native businesses, they're getting destroyed, right? S&P companies, average revenue down 40%. There will be people like in the airline industry where revenue dropped 80+%. And so I think you've really got to unpack what are the sectors that these companies are in, how have consumer behaviors changed, how quickly will they come back, and then holistically, what's that GDP number? Is it above or below 35% contraction in the economy? 35% contraction in a quarter is an unfathomable number. 52 million Americans who lost their jobs in 4.5 months. Unfathomable. There's about 30 million Americans who are on continuous unemployment, right? Kind of they continue to draw unemployment. 30 million Americans. There's about 155 million Americans in the US workforce. 30 million of them, about 1 in 5 Americans who are in the workforce are currently unemployed and pulling unemployment insurance week after week after week. This is absolute chaos, yet the stock market's up. And people are getting a crash course, and this is what happens in an economy when the Federal Reserve and the US government steps in and they manipulate asset prices. So we'll see how it ends. Before I start taking questions here, remember, please smash the like button so more people on YouTube will watch this. Please subscribe to the channel. And I will put here in the comments, I write a daily letter every single day to about 50,000 investors. And if you want to get on that list, it's just pompletter.com. So go ahead and subscribe and you'll get that email every single day. Please start asking questions here. The only other thing that I had written down to talk about is I'm very interested to see how the virus numbers that are coming out in a number of states, right? There's been about 1,000 reported deaths. Again, we'll caveat this whole conversation around the virus with, I can't tell you what the real numbers are. I don't know if they're undercounting, overcounting. I have no clue. I see the same anecdotal evidence that other people see of the numbers being wrong or inaccurate, right? There was a guy in Florida who died in a motorcycle accident, yet he's counted as a COVID death. But at the same time in New York, there's a total number of deaths have increased, but they don't understand where a lot of those deaths are coming from. So who knows if the data is undercounting, overcounting. All I know is we've got bad data. We're making bad decisions because we're counting on that bad data. And so if the hospitalization numbers that are growing in a lot of these states, if those death numbers are growing, what does that mean? Are we going to go back into some sort of soft lockdown? Or are we going to go into more of a shelter in place across the economy? We don't know, but that's going to be something to watch. So keep your eye on that. All right, let me see if I can start answering these questions. Just fire away with as many questions as you got, and I'll do my best. I'll stay on for about 35 minutes, and we'll try to run through as many of these. Everyone is, what are people doing with their stimulus checks? Yeah, look, here's the craziest part of this entire situation. If you look on Robinhood, for example, when those stimulus checks went out, there was very compelling data that showed a lot of people literally took their stimulus check, put it in Robinhood, and started buying. So people were just trading in the stock market. And if you look at when they did that, they basically got those stimulus checks right at the bottom of the market. And so you've got all sorts of the billionaires and hedge funds and Wall Street folks on television being like, scratching their heads. People are shutting down their hedge funds, being like, I don't get it. The market makes no sense anymore. People saying, hey, we're down on the quarter, right? How is the stock market rebounded 50%, yet people haven't made money in the hedge fund world? Well, it's because retail investors, all they knew was, I just got some free money. And so they went and they put in the stock market and they've ridden this. And is it a kind of enthusiasm fueled run? Absolutely, in the kind of retail and day trading space. But at the same time, I would argue that actually what retail is showing us is they better understand the market dynamics at play than the professional investors. Why? The professional investors are looking at spreadsheets and they're trying to estimate how much is this airline's revenue going to go down. And what retail investors are saying, you see it all over the internet. People are like, dude, the airlines aren't going away, right? They're not going, we're never going to not fly again. And so you can sit there with your spreadsheet and try to time the market, do whatever. I just know that United Airlines stock went from $80 down to $20. Seems like a good time to buy. And all of a sudden when it rallies, they catch that rally, right? So you have to remember that just like in the startup world in Silicon Valley, we tell founders all the time, you can have the best team and the best product, but if you pick the wrong market or the wrong time, you won't win. Right. And there's a million examples of this. But if you actually have an okay team and an okay product, but you pick the right market at the right time, it will carry you. You will be super successful. Same thing here in investing is you don't even have to be the best analyst. You don't have to do all of the kind of hardcore spreadsheet work. All you had to do was understand the stock market dropped 30%, and that is a pretty good drop. Investors bought in the retail space, and as that stock market recovered, they benefited from it. And so you could argue that both the professional investor and the retail investor have never done this before. No one's ever lived through a global pandemic that is investing in these markets. And so retail outsmarted the professional investors, but they were optimizing for two different things. The professional investors were trying to time markets, and the retail investors were simply getting exposure with free money that they had recently gotten. So that's where we get where we are. Let's see what else we got here. Will housing prices continue to inflate up in a broader economic decline due to the trend towards work from home and social unrest in big cities? This is a great question. So basically the way that I think about this is there's two key components. You have the national averages, and then you've got very region or city specific. So compare the home price in the residential sector continues to go up. You have mortgage rates coming down. Like I said, 30-year fixed rate about 2.87% across the country. But then if you look in somewhere like New York City, for example, there is a plethora of supply on the market, and prices are falling very, very quickly. And so how do you kind of reconcile those two data points? Well, some of it is people don't want to live in a place like New York City because in the beginning of the pandemic, there was all sorts of kind of fear around the virus. It was a hot spot. It was going really poorly. You get people who say, look, I just don't want to be confined in an urban area. I want to move somewhere else. You also get kind of the social unrest scare some people. And then on top of all of that, it's a very rent heavy city, right? So actually what you end up getting is a lot of renters and much less buyers in a city like New York compared to other places. And so I think that you've got to kind of look and say to yourself, hey, am I as an investor looking to benefit from the more macro national average and trends, or am I very specific to a market? So San Francisco and New York are much more similar than, let's say, New York and the national average. And so I think that's where people are starting to understand that outside of these major metros, you're getting these housing prices inflating. It's because there's cheap capital. And again, remember, it's a fixed rate mortgage. And so there's going to be long-term impact from a lot of these kind of things that people are doing right now. But again, time will tell kind of how long that happens. I have been on record as saying that this work from home movement, it would not surprise me whatsoever if you start to see two things. One, homes that are being built, right? New construction in the US jumped almost 20% in June. Now, it had dropped because most construction was shut down in April and into May. So it's easy to kind of have a big jump when you're coming off small numbers, but it was almost 20% jump in the month of June in new construction in the United States. A lot of that new construction, people are going to start actually saying, I only want to buy a home that has a legit home office, right? And maybe actually need two, because myself and my significant other, we're both going to work from home. Now, what does that look like? I don't know, right? As a kid, I remember my friends and my parents and houses that we would look at, whatever, they would have kind of these home den offices, right? Which was basically kind of like a small room. It usually didn't have doors that like fully closed. And it was kind of like, oh, you can go in there and do some work. It wasn't optimized for things like Zoom meetings, phone calls, all that kind of stuff. And so don't be surprised if you start seeing homes being built out with super legit offices. They're promoting or marketing the fact that, hey, this is a home specifically built to work and live in. And then even seeing things like audio, at-home audio, all kinds of video and AV type work being done in a home so that it is optimized for working from home. And then again, one of the things that we don't know is, are we going to see kind of just one big office, or are we actually going to start seeing homes that come with two home offices so that you can live and work in the same place? We'll see how that kind of plays out. But I think that is definitely a trend that people are going to start benefiting from. You'll see it in new home construction. You may see renovations happening. And then on top of that, anybody who's got like an extra bedroom, they may start converting those to home offices. And as they market homes for sale, that will be a big selling point. It's the Fed. They never run out of bullets. That's definitely true in the sense that they can always do more of the same. The question becomes, and this is the wildest thing that I'm going to talk about today, is the Fed has historically always said we have a 2% inflation target. Coming out of 2008, 2009, they didn't even come close to it, right? We kind of stayed under that 2% in terms of the CPI reported number, the official number. Now, I've talked in the past about there's a lot of studies that show not everyone has the same inflation or experience the same inflation. So if you kind of break down the socioeconomic ladder into 5 separate buckets, the bottom 20%, in many cases, there's reports that show they may have been experiencing 8 to 10% inflation coming out of 2008, 2009 crisis. Now, the official CPI number never hit 2%, but when you get kind of 8 to 10% for the bottom 20%, then obviously that's something we've got to pay attention to. So when the Fed can't run out of bullets, they are now talking about I think it's the Dallas Fed president came out and said that he actually is not worried about inflation at all. He's not going to worry about it until we hit 2% or even overshoot it a little bit. There's a lot of countries around the world who have said, oh, it's okay if we go over our target. And the next thing they know, they lose discipline and they end up actually destroying their currency, hitting hyperinflation, all kinds of bad things. Now, I'm not claiming that's going to happen in the United States. But what I am claiming is that the rhetoric and the discipline that we typically are able to plant a flag in the ground and say, the United States is a leader in this area is starting to decay away, right? That rhetoric is starting to actually be a little scary. The discipline, you can see them starting to do things that are not as disciplined as they have been in the past. And so does that ultimately lead to some sort of bad economic situation? History would tell us that, yes, it inches us closer. Now, are they going to have some sort of hyperinflation situation in the next 3 to 5 years? I personally don't believe that's going to happen. I do believe that we will have inflation and even see something over 2%. And definitely in the unofficial numbers, we could see 10+% in certain socioeconomic categories. But it's something to keep paying attention to is why are all of a sudden are people at the Federal Reserve talking about overshooting the 2% target? Well, they understand they're printing trillions of dollars. That's what's going to happen. And so again, if you go back to the framework, to be an investor in this market, you don't have to be a genius. All you have to understand is the macro structure of an economy. And the macro structure of an economy is if we print tons of money and devalue the currency, asset prices will explode. And we're literally looking at, we're right kind of on the cliff, and we're looking at, are they going to stop printing money or are they going to continue? If they let these monetary stimulus package programs from March run out, that means that they would stop printing money. You would see a big contraction in the Federal Reserve's balance sheet. But that's unlikely, right? We know the Republicans are going to unveil a monetary stimulus package at the beginning of this upcoming week. We know the Democrats put forward a $3 trillion plan previously. So we are looking at, whether it's the Republicans or the Democrats, $1 trillion to $3 trillion in proposals. By the time they get these things settled, again, I believe that we're going to see, call it $2.5, $3 trillion in a package. And so if there's going to be much more monetary stimulus coming down the pipe, it is likely that they will continue to inflate asset prices over the coming months. And so there's a lot of people saying, hey, the stock market's had this incredible run. There's no way that this can continue. Oh, yes, it can. Absolutely, it can. And structurally, if they continue to print money, you're going to see asset prices explode, right? And so I think that's something that people have to understand is stop looking at, did the revenue of a business go down? Well, of course, it all went down. There was a global pandemic. The government shut down the businesses. But if they are just pumping money into the economy, the actual fundamentals of the business don't matter for short-term price movements. Now, again, where that balance comes back, right? And this is, I think, where the professional investors are scratching their head saying, what's going on here? Is there's going to be a day of reckoning where we shift from the macro structure being more important than fundamentals to, okay, the macro structure is evolving or transitioning back to not as much money printing and the fundamentals will become more important. On that point, there's likely to be kind of the pullback in prices. But again, the macro structure is built over a very long period of time. That 45-degree angle in the stock market, if you zoom out over decades, is because of the inflationary nature of the currency. So keep going. People who are working will start to complain. Why work 40 to 60 work weeks, 40 to 60 hour work weeks, while others essentially get a vacation for 70% of the pay? UBI is coming. So absolutely. We saw this back in March and April. There was plenty of employees who were going to their employer saying, dude, just fire me. Like, I'm going to make more money on unemployment than here, but you've got to fire me. And so I think that we kind of already had one whole, iteration of that. It would not be surprising to see a second iteration of that. The thing I'm less worried about is kind of essential, or these workers complaining and asking to be fired, because we kind of already had the first iteration. What I think is more important to pay attention to here is essentially this beefed up unemployment insurance is a very watered down poor man's version of UBI. Right? It is the government supporting tens of millions of Americans. And then when you get the stimulus check, I think they sent the stimulus checks in the first round over 100 million Americans. So about 1/3 of our population. Now, if they do a second one, again, watered down, temporary, poor man's version of UBI. So in a world where 10 years ago, we could never imagine UBI coming to the United States, now we're actually inching closer. And it's almost like we're testing it, right? We've got early iterations and we're saying, oh, does it make sense to call it unemployment insurance and beefed up? What about if we call it the stimulus check? They're testing the waters. They're seeing what works. What's the impact? How much? Like all of these things. I have no doubt over the next 10 to 15 years, we will have UBI implemented in the United States, right? Now, whether you call it universal basic income, you call it modern monetary theory, you call it something else, right? You call it purple cows, whatever you want to do. All I know is that the government is going to continue to support citizens more, not less. I don't agree with that, right? I actually think that's a horrible idea, but that is what is likely to happen because, again, it is in the interest of politicians to continue to give more things to people because it sounds good. People like the safety. They feel like, oh, they're helping me. But it is absolute political suicide for a politician to take this stuff away later, right? So you get in a really, really weird world where I am incentivized to give you more things, not take them away. And the number one thing that I can do that gets you all excited is I can give you money. And now there's precedent for doing it. And so it starts in times of crisis. But again, never let a crisis go to waste, right? It would not be surprising to see this become something that isn't as temporary, something that is much more kind of permanent in nature. And so I absolutely think that UBI, modern monetary theory, whatever you want to, helicopter money, whatever you want to call it, it's coming. I don't know if it is like a 2020 implemented for the long haul type thing, but over the next kind of 3 to 5 years, I think that we start to see the actual plans being implemented. And then kind of 10 to 15 years, it's something that's just, people who are growing up in the workforce at that time, they don't know anything else. They just have always known that the government will give you a paycheck, which is pretty crazy. And so, yes, real people need money to survive if this continues to be riots and revolutions. So here is one of the things that I know will be a very divisive issue. So I'll just call it out right now. Again, there is a difference of opinion between people who believe that the government should intervene and should manipulate and artificially prop up the economy, and people who believe that you should let free markets reign and kind of let the economy do what it's supposed to do. Now, those two groups are optimizing for two very different things. Right? The group that believes that the government should step in, they're optimizing for mitigating short-term pain, right? And the Federal Reserve's job in some cases is to look at jobs, right? Is if people lose their jobs in the short term, then the Federal Reserve feels like they're not doing their job. And so now you get somebody who's optimizing for short-term decision-making and worrying about long-term implications later. The other group, the free market group, believes that, look, there will be short-term pain, but over a long period of time, this is a better system. It mitigates damage long-term, and it actually creates a more robust, kind of secure, sturdy economy over a long period of time. And so both of those groups are actually right? That's the part of the divisive conversation that no one wants to admit. Both groups are right. If you want to optimize for short-term pain mitigation, you should allow the government to step in and print trillions and trillions and trillions of dollars, and they should stuff it in every nook and cranny in the economy. They should give money to businesses. They should give money to individuals. They should bail out local, state, and the local and state governments. They should bail out every single corporation. They should do all that stuff, right? That's how you mitigate short-term pain. But obviously, there's a price to pay for that stuff over a long period of time. So they're correct in, if you want to optimize for short-term pain mitigation, go ahead and let the intervention to happen. On the flip side of that argument, the free market folks, they're correct as well. That if you allow the free market to reign, then you will have short-term pain, but you'll have a much sturdier, secure, kind of sustainable economy over a long period of time. So what ends up happening is when people have this debate, you've got to ask them, well, what are you optimizing for? Are you optimizing for short-term pain mitigation or long-term sustainability? The correct answer, in my opinion, again, my opinion, is you should always optimize for long-term sustainability, right? You can do things in the short term that can mitigate some of the pain, but there's going to be pain, right? It's like saying to a business, hey, you raised money, you have a product, that product's not selling very well, you're spending much more money than you're making, and you've now been doing this over and over and over and over again. At some point, you got to shut down the business. You spend more money than you make, and you got to shut down the business. But if all of a sudden the government steps in and says, no, we're going to give you more money, right? We're going to give you more and more and more and more money. You can actually prolong that business for much longer. You can artificially prolong it so that now those resources, those individuals, all of that capital ends up getting sucked up by an inefficient, non-productive business. If the free market allowed you to clear out that business, would people lose their jobs? Absolutely. But then they would go and find jobs at something that's much more sustainable, right? And again, you have to look at what are people optimizing for. People who want the government to intervene, optimizing for short-term pain mitigation. People who want the free market to kind of take over, they're trying to optimize for long-term sustainability. Both arguments are right. Absolutely fine. No problem with it. You just got to realize, what do you as an individual, where do you come out on that debate? Not so much around should the government intervene or not, but what are you trying to solve for? Are you trying to solve for the short-term pain mitigation or that long-term situation? So socialism for the rich, they are showing us that they generally do not work for us. They're about to buy up our assets with our money. So this is by far probably the biggest thing that people miss, in my opinion, about all of this is I've got a friend, Travis Kling, who said that monetary stimulus or quantitative easing is just UBI for rich people, right? Quantitative easing is just universal basic income for rich people. And what that means is when you print a bunch of money and you inflate asset prices, what you're doing is you're bailing out the rich. But when you bail out the rich, everyone looks at the asset price inflation, and they know the top 50% of Americans own those assets. So it's very clear that you, quote unquote, bailed out the rich. But the flip side of that, and a really important point, is inflation like that through this quantitative easing is a massive hidden tax on the bottom 50%. And so what you're literally getting is the rich are getting richer faster and the poor are getting poorer faster. And so this socialism for the rich, it's not just socialism for the rich, it's actually socialism for the rich and a punishment for the poor. And so what we are seeing is a government that is optimizing specifically to bail out the rich and punish the poor. And they come at it with, oh, we gave you $1,200. Okay, you gave the people $1,200. But there's the billionaires in the United States made over $500 billion so far. $500 billion during this crisis. They've gotten richer. I think it's like just over $500 billion. How is that possible? Well, it's because they're getting bailed out by the government because the government is printing so much money and they're inflating asset prices. So socialism for the rich, punishment for the poor. That is what is going on. People can debate whatever they want, but at the core, that is how we get in a world where there's a massive wealth inequality gap. And again, I go back to, that's not a bug of the system. That is a feature. Now, what you at home can do is you have to get educated, right? You've got to understand how the system works so that you can position yourself so one, that you're protected, so you don't want to be punished with the poor, and then you want to position yourself so that you can benefit with the rich, right? Why is it that the rich people aren't walking around with all cash? Well, it's because they understand by owning assets, that's how you continue to build wealth. Well, why are all the poor walking around with 100% of their wealth in cash, not being able to pay for or living paycheck to paycheck? It's because they haven't been able to save the money and invest it in order to get out of that situation, right? That is a structural issue. Now, I've got a whole bunch of ideas as to how we actually solve that issue. But if you are sitting watching this right now, you've got to understand, this is the system that I'm in. Here's the rules of the game. If I want to win this game, I've got to use the rules to my advantage. I can't sit around with cash because that's going to get devalued today and in the coming years. And I've got to get into assets where the asset prices are going to get inflated. What those assets are, we can get into kind of all the details there. But that ultimately is what is going on. All right, keep asking your questions. And smash the like button, subscribe to the channel. I'll put this in here again. If you want more of this content on a daily basis, please subscribe to the email that I send every single morning. 50,000+ investors end up reading it. I typed it wrong because I'm an idiot. So if you can, go subscribe and I will send you an email every morning. What other questions here? Trade your fraudulent fake dollars for silver, gold, and Bitcoin, and then ignore the propaganda. Yep. So basically, let's talk a little bit about inflation hedge assets, right? So real estate, gold, silver, and Bitcoin. When I look at this, these are some of the most attractive assets to me right now, right? And why is that? So again, when you look at the gold price, it went from $20 to $1,900, all because the dollar's been devalued. Bitcoin this year is up 35%. It's the best performing asset class in the US this year. Why? It's because the dollar's being devalued, right? Bitcoin hasn't changed at all, right? There was the halving, but nothing's really changed with Bitcoin. The dollar is being devalued, asset prices are being inflated. So ultimately, I think that the four really interesting assets to look at: real estate, gold, silver, Bitcoin. Now, I am 32 years old. I have an incredible risk tolerance, and I have in my head a very specific amount of my wealth that I'm willing to lose, to go to zero, right? And so I choose to take that risk capital, that high percentage of risk capital, because of my age, because of my lifestyle, because of my risk tolerance, and I choose to invest in what I believe out of those four assets is going to be the highest performing of them, which is Bitcoin, right? So kind of Paul Tudor Jones famously in the last couple of months decided to take 2% of his assets and put it in Bitcoin. And in the letter where he talked about it, he said, the reason why I am doing that is because I believe that Bitcoin will be the fastest horse in this category, right? And kind of the inflation hedge assets. So real estate will go up, gold will go up, silver will go up, but Bitcoin will go up more than all of them, mainly because it's the smallest market cap. It's only about $200 billion market cap today, and it's hyper volatile. So when volatility works against you in drawdowns, right? Bitcoin dropped down 50% in a single day earlier this year. Gold dropped 12 to 15%. Equities down 30%. And kind of real estate kind of stayed really flat, frankly. But now all of a sudden, when you go back up and you get the inflation of asset prices, gold's up, 20% or so. You're going to see equities up, right? But now all of a sudden what you're going to see is Bitcoin is the best performer because it's the most volatile, it's the smallest market cap. And so that's what I've chosen to do with my wealth. And why I've chosen to do that is because gold, silver, real estate, and Bitcoin are all inflation hedge type assets, but I believe Bitcoin will outperform the rest. This is not financial advice. There's risk. Go do your research. But that's why I've chosen to take a percentage of my wealth and do that. Again, I'm 32 years old. I've got high risk tolerance. I'm willing to lose the money that I've put in. So that is kind of how I think about it. Now, when you look at those other asset classes, right, when it's real estate and precious metals are doing pretty well this year, right? Gold's up like 20%. And I believe it's going to continue to go up. Right. I just don't think that you're going to see a $4,000 gold price in the next 2 years. Right. I could be wrong. I would love for all of my friends who are gold investors to be wrong and for there to be a $4,000 gold price. I just don't see that happening. I see gold continuing to kind of grind up. And maybe I think back in like March or April, I said that I could see gold hitting kind of 2,000 to 2,500 over the next 2 years. I still kind of think like that's a pretty good target for gold to get to. But maybe I'm wrong and I underestimated it and it goes higher. But I do think kind of $2,000 to $2,500 would be interesting. Now, when it comes to real estate, we're seeing residential home prices go up. Right now, doing something like buying real estate in Manhattan, some of the prices of the real estate is actually all-time lows, right? Or in kind of local lows, not all-time lows, but local lows. And so what that means is there's been this massive sell-off in prices. And so people who have the capital base can come in, be opportunistic, be intelligent about how they buy and where they buy and what they buy. They're going to end up making a lot of money over the coming years. Remember, when you make investments in real estate, majority of the returns you will receive is based on the price that you pay at the time you buy it, right? If an asset is worth $1 million and you pay $950,000, you bought it for $50,000 less than it's worth. If you bought it for $1,050,000, you paid $50,000 more. But if we buy the same asset and I buy it at $700,000 and you buy it at $900,000, of course I'm going to make more money. I bought better than you did, right? So the price you buy the asset at is going to be one of the major determinations of what's the actual return financially you're going to get out of that asset. Well, if asset prices are down, there's nothing that has changed with the assets in New York in terms of the actual assets themselves over the last 5 months. Now, demand has shifted, and because demand shifted, prices drew down. But if you believe that people will want to live in New York City over the coming decade or two, and that actually is going to return to more normal levels and even potentially go higher, then of course buying at low prices would be a smart decision. Now, if you believe that New York's over, no one wants to live in New York anymore, this whole virus and pandemic thing is going to get everyone out of kind of urban areas, and all of those people are going to move out, and demand will actually be lower in 10 years than it is now, then maybe buying here is not a good idea. But that's the type of calculation you've got to look at. And so I think that real estate specifically, I see a lot of people saying, hey, I want to go get into real estate right now because they see prices down. The price you pay is going to determine the return that you get. And so you got to be smart about the macro trends, right? Is the place that you're buying in something that you see demand being higher or lower in 5 to 10 years? And then what's the price that you're paying? And then look, the other thing is use the financial incentive you have. There's a 30-year fixed rate mortgage national average of 2.87%. It's 100 basis points lower than it was a year ago. You have access to cheaper capital. Of course, there's people who are going to be excited about that and they're going to use it to their advantage. So I think that people should absolutely go ahead and take advantage. Bill Pulte, what's up, man? If you guys aren't following Bill on Twitter, you should absolutely be following Bill Pulte. He's doing a fantastic job. I see him here in the comments. Let's see what other questions do people have. If we're judging value of these assets against dollars, what's the point? At what point do you want dollars when they keep devaluing? So, Manuel, that's a great great point, which is, again, if you go back to the stock market since 1971 and you say, okay, the stock market is priced in dollars, it's up a lot. If you price the same stock market in gold, it's about flat, just a little down. If you do it in Bitcoin since 2011, it's down significantly. And so it's all about what is the asset being priced in. Dollar is obviously the global reserve currency, and so everyone chooses to do that. And it ultimately is going to be something where, how do rich and wealthy people get rich and wealthy? They buy assets and they hold them for very, very long periods of time, right? There's basically two strategies. So this is actually an important point. There's two strategies to get rich in the United States. Well, three. You can inherit money, but none of us can control that. So throw that out the window. The two things that you can do to become wealthy in the United States are, one, you can buy assets that are priced in dollars and hold them for very long periods of time. And when that happens, those assets will actually increase in value because the dollar is being devalued. So whether it's, again, real estate, gold, stocks, Bitcoin, whatever it is, over very long periods of time, you'll almost get this like 45-degree angle straight up into the right because the dollar is being devalued in a very kind of intentional, about 1.5–2% a year. And that's what drives that price inflation. So that is one way, is get out of cash, get assets, hold them for a long period of time. The second thing you can do is invest in innovation. So the most innovative companies in the world drive the most returns, right? Again, innovation leads to financial returns. Now, there's two ways to do it: public markets and private markets, right? Public markets, there ends up being a lot of people who make a lot of money by investing in something that's innovative, and the stock price goes up. But the susceptibility that people have is that they end up selling if the price doubles or triples. So they buy a stock, let's say it's trading at $50, it goes to 100, they sell. Or they buy it at $50 and it goes to $150, they sell it. Well, all of a sudden, that stock over 10 years goes from $50 to $500. And they don't hold it for a long period of time, because in that case, liquidity actually can serve as a detrimental thing. Right? The fact that you have the liquidity means that human nature can take over. You feel great. You just made a bunch of money. And so rather than press your winners, meaning that it goes from 50 to 100 and you invest more, you goes from 50 to 100 and you sell, right? And then you miss majority of the increase in value. But innovation drives returns. Now, in the private market, the illiquidity actually serves as a benefit in many cases, right? If you go and you talk to an angel investor and you say, hey, you invested in Uber at a $5 million valuation. When it was worth $50 million, would you have sold? With hindsight bias, they say, no, absolutely not. I knew it was going to be a multi-billion-dollar company. You made 10 extra money. Are you sure you wouldn't have sold? What if when it was trading at $500 billion or $500 million and you had made 100x? Would you have sold? No, I never would have sold. No way. I don't know, right? And so when you then kind of look at it as it goes up and up and up and up, at what point would they have sold if there was liquidity? There's very few people who could have held from $5 million valuation up to, whatever it was, $40–50 billion valuation. And so the illiquidity actually serves as a benefit in those scenarios. So you've got to be able to understand, if I want to be wealthy, what are the two things I can do? Buy assets priced in dollars, hold them for long periods of time, and allow kind of the structural system to actually drive my returns rather than me be the genius. Or I can invest in innovation, public or private markets, and I've got to be right and I've got to be early in order to capture significant upside. What do most people do? They say, well, why don't I just do both? Why don't I take a percentage of my portfolio, put it into assets, allow that system to kind of not get rich quick, but get rich for sure, and allow the structure of the system just to make me wealthy over many decades. At the same time, I'm going to invest some percentage, usually a smaller percentage of my net worth, into innovation. That could be through venture capital, private equity, public markets, whatever it is. And then that's where you try to really hit kind of outsized returns. So that's how these portfolios are built. Go look at all of the wealthiest people in the country. That's basically what they did. Now, they supercharge that strategy with an additional thing, which is the innovation that they invest in normally is innovation that they own. Right? So they own equity in their own business. And the reason is because rather than put a couple $100,000 into something and own a very small percentage, they say, I'm going to create this value and I'm going to own a very high percentage of it, right? Whether it's majority or a large minority position. And that's how they create wealth. And so ultimately, if you understand those two things, you can position yourself to be wealthy. All right. What other questions? What other questions do we have here? People are asking, I just see a bunch of questions about Bitcoin. Basically, the whole idea behind Bitcoin is so far, it's up like 35% this year. It's best performing asset or asset class. It's, stocks are essentially flat. You've got gold that's up about 20%, Bitcoin up 35%. Real estate in many markets is trending upwards, but still Bitcoin has outperformed. And in June of 2019, right? So let's go back. This is my victory lap a little bit. This is me with my internet receipt. So in June of 2019, I wrote a piece that said, I believe that we are heading into a scenario that is going to be rocket fuel for Bitcoin. And that scenario, it needed three things to occur. We needed a significant decrease in interest rates. We needed large printing of money, and we needed the Bitcoin halving in May of 2020 to execute correctly. We've got all three of those things that have happened. I did not believe that we would see 0% interest rates or that we would see two emergency cuts to drive interest rates to zero. I did not believe that we would get trillions and trillions of dollars of monetary stimulus. But I did believe that we would get the Bitcoin halving to execute successfully. So I thought we'd get a drop in rates, not zero, but a drop. And I'd see printing of money, but not trillions of dollars. So really what's happened here is we've gotten a way bigger drop than I thought. We've gotten way larger amount of money printed, and we had the successful Bitcoin halving. There could not be a better scenario over the next 18 months for Bitcoin to be walking into. I believe it is absolute rocket fuel for Bitcoin's price because you have a macro environment that is providing all of the ingredients for this asset to explode in US dollar value, right? Again, it is the most volatile of all assets. And therefore, because of that volatility, when it goes down, it works against you. When it goes up and you're long, it works for you. And so that's my entire thesis around Bitcoin is that we are going to see an absolute explosion in the US dollar price, right? I'm on record. Again, there's risk. Do your research. This is not financial advice, but I am on record saying back in January, I believe it was, that we would see Bitcoin go from, at the time, about $10,000 to over $100,000 by the end of December 2021. So the end of next year, seeing a Bitcoin price of $100,000 or more. Today, we sit at about $9,500, right? So that's kind of where I think everything's going. We'll see what happens there. But I think it's very, very interesting. Okay, there's a question about, would you say a young person starting their career should mostly do high risk, high return investments like crypto, tech stocks, etc.? So I think that there's two things that young people should do, right? And the way that I would do this is if I was going back, let's say I was 20, I actually have a brother who's about 22, 23 years, or maybe he's 24 years old. I think he's 24 years old. And so at 24, we just went through this exercise and we were talking about all the different investments that he could make. And what I said to him was, I said, listen, the amount of capital you have right now is going to be immaterial in your life, right? It's nowhere near what you're going to have in the future. And so today, you should take as much risk as possible with that capital because it is likely that if you lose it, it won't matter over the long run. And if you're right, it actually could grow into something important, right? And actually be meaningful in your life. Now, as part of that, as you get older, you should start to go from 100% high risk, 0% kind of low risk, to maybe you go 80% high risk, 20% low risk, right? And so kind of there's a continuum as you get older. And older could be you go from your early to mid 20s to your late 20s, right? And now you say, hey, look, I'm actually thinking about getting married, or I'm thinking about starting a family, or I've got other things that I want to worry about, buying a house, traveling, whatever. Then maybe you start to say, okay, you know what? I'm going to take 20% of that high risk capital previously, and I'm going to start diverting that 20% into an S&P and let it compound over time. Right. But right now, when you're 22, 23, 24 years old, or even in 18 or younger, right, there's a whole group of people that will say, oh, you should let compounding work for you. You should let the stock market of 8% kind of annualized compounding work for you. Absolutely. But I am of the belief that you have to invest in innovation in order to drive financial returns. And there's a way to get rich, but there's a difference between rich and wealthy, right? And being rich just means that, and this is going to sound crazy, right? But in America, being rich is like having $1 million when you retire, right? That's great. Most young people, when you're looking at it and you've got a couple $100, couple $1,000, you say, wow, if I had $1 million, I'd be rich. In the grand scheme of things, having $1 million is not that much money in today's society, right? $1 million today, when you fast forward 5-10 years from now, is going to be a lot less because, again, if it's in cash, the purchasing power of $1 million is going to deteriorate significantly. So $1 million may seem like a lot today, but 5 or 10 years from now, $1 million is going to be worth much less. And so what you've got to be able to do is you've got to understand, do I want to be rich or do I want to be wealthy? And if you want to be rich, let compounding go to work for you, right? But if you want to be wealthy, and I'm talking about tens of millions of dollars, and you're young, the way to do that is to invest in innovation. So you can take capital and you can deploy it into highly innovative things. Most young people actually have a better understanding of what is innovative than older people, right? If you went and you talked to a lot of young investors 2 years ago, and you said, hey, is electric cars going to be a thing in the future? They'd be like, duh, every car is going to be electric. Right? Or if you ask them, what about Cash App and Square, right? They'd be like, of course, like I use that all the time with my friends. So there's all sorts of things that young people understand because it's part of their daily life that older people have a hard time analyzing and kind of identifying. So you know the things that are innovative. By investing there, you can drive outsized returns. The second thing you can do as a young person is get started early, right? So again, the number one way to get wealthy in the United States is to own equity in things, whether you're an investor or you're the builder. Why not do both? Invest capital and start a business. That business doesn't have to be a venture scalable, venture capital type business where you raise millions of dollars and it's got to be the next, Facebook or Instagram or Google or Twitter or whatever. You can have a great business where literally it throws off $500,000 in cash a year in terms of net owner earnings. And if you invest that capital correctly, you'll be worth tens of millions of dollars by the time you're in your 40s and 50s. So you don't have to necessarily hit grand slams. You can hit singles, doubles, and triples. And it's all about the cash flow in those businesses rather than the equity value, right? So I think that there's a whole bunch of things that young people can do. I tend to think that the idea of diversification is horrible advice, right? If you talk to a Warren Buffett, for example, him and Charlie Munger are on record as saying that diversification is for people who don't know what they're doing, right? And concentration builds wealth, diversification protects wealth, right? So if you don't have money, going and being in a highly diversified portfolio that's going to make you between 5 to 8% annualized at 18 to 22 years old is stupid. It's literally stupid. And anyone who tells you that that's what you should do doesn't understand how to actually build wealth, right? If instead they said to you, you should go and do a lot of research and work and either create a business where you've got highly concentrated net worth in a single asset and grow that asset, or you should make investments in things that you think are highly innovative, that you've done the work, right? Analyze the risk. And if you're right, it will grow. That concentration is what's going to build your wealth. The diversification later when you have money, that's where you'll actually end up protecting it. So I think that you've really got to understand that. I see people asking where Polina is. She literally is taking a nap right now, probably because she knew I was going to come do this and didn't want to be annoyed. All right, I'm going to take 5 or 6 more questions here. What else do you guys have? Yes, Jeff Bezos almost doubled his wealth after he gave his wife like $30 billion, right? If you understand that, I mean, that's insane. He's the wealthiest guy in the world, and he gave his wife or ex-wife, I guess at this point, $30 billion. Absolutely nuts. People like to look rich more than they like to be wealthy. Don't be that, Marlo. Yeah, look, this is one of the things. There's a picture I've talked a bunch of times about of Jay-Z that's floating around the internet. And basically, there's 2 pictures of Jay-Z. One of them on the left is Jay-Z's got all the chains and the earrings and all kind of the symbols of wealth, a big watch, all that kind of stuff. And it says Jay-Z net worth 100K. And then on the right side of the image, it has Jay-Z in just a black T-shirt with a blazer on. And it says Jay-Z net worth $100 million. And throughout my entire life, the richest people I know don't act like the richest people, right? And it's because they understand, why do I need all of the flashy things? Now, do they spend money? Absolutely. They got a lot of it, right? So they'll do things. They'll buy a nice car. They'll buy a nice house. They'll do all that stuff. But what I mean is they don't do it over and over and over and over again, right? I've got friends who literally will say, hey, this year I'm going to make $5 million. And I promise myself every year that I hit a $5 million target, I'm going to buy myself a nice car. And I have a budget up to $250K. A lot of people say, wow, you're buying, $250,000 car. Well, they made $5 million. So actually on a percentage basis, like that's pretty cheap in terms of a small amount of capital. I've got friends who they make $150,000 and they literally spend $100,000 every year on nonsense, right? And so it's just, how do you do that once you take taxes out and all this kind of stuff? Well, they end up going into debt. And so what you have to realize is it's all relative. There is no kind of one simple, silver bullet for all this stuff. But there are many lessons over history that have shown people, how do you build wealth? How do you accumulate that wealth? And then how do you actually make sure that it's something that will continue to grow over long periods of time, and you don't have to worry about any government, forget just the US government, any government eroding away your wealth and savings by just printing money like they're doing. All right, 2 more questions. Let's see. Robotics. Yeah. So here's the thing. And I see people talking about ARK and Kathy Wood and all them. So as many people know, I've interviewed Kathy Wood from ARK Invest twice on the podcast. She's probably one of my favorite investors on Wall Street because she understands that's where innovation leads to returns. I personally have a very deep conviction in robotics, mainly for 2 reasons. One is the virus has shown us that we're going to have to nationalize, not nationalize in terms like the government takeover, but we're going to have to bring back a lot of supply chains and manufacturing facilities to the United States. If we do that, costs will go through the roof because American labor is so expensive. And so it is going to have this resurgence in 3D printing, robotics, all sorts of different things that can help continue to drop the price of manufacturing and supply chains here in the US. So we have to have a resilient supply chain and manufacturing industry, but it's going to take robotics and all sorts of things there to continue to drive that price down so that people can still keep the profit margin that they currently have. So I'm very, very interested and excited about kind of all of the things we're going to see in 3D manufacturing and robotics. That is just one application of it. And ultimately, yes, will people lose their jobs because of robotics and 3D printing? Absolutely. But I believe that what ends up happening is that those people will then go find more productive work to do. So the example that I always use is at one point, it was like 98% of all people in the United States were farmers, right? Well, obviously, we got much better at the food supply chain, technology, all that kind of stuff. Now it's about 2%, I believe, is farmers in the United States. Well, what happened to all? We lost all the jobs. Yeah, but those people went and they found much more productive things to do. We had the Industrial Revolution. Like, look at the country and the economy that we built, right? And so I think that that's the same thing that happens here. Is we'll just continue to get more and more people who will go find more productive work to do. I don't get so caught up on people losing their jobs because of technology. Ultimately, technology is very deflationary, right? My friend Jeff Booth wrote a book about this. Essentially, the idea is that as technology continues to become more prevalent, you get deflationary trends at play. So the cost of things goes down, and you kind of free up that labor to go do other more productive things. All right. Do you think real estate prices will drop with forbearance expiring in September? I think. Oh, there's Polina right there. Polina just woke up from her nap.
No, I did not.
For anyone who is interested.
Hi guys.
No.
I got some friends in the chat. I was chatting with them.
All right.
Okay, I'll let you go.
That's Polina's way of telling me to shut up. No, so I think that people are saying, "Hey, Polina, Miss Pomp." All right, so hi, Polina, welcome, the main host. All right, so the whole idea around real estate prices essentially is, yes, there is going to be potentially this situation that forbearance will go away. People will actually kind of get hurt by that. Real estate prices go down. But if there is still cheap capital in the market, I believe that we can continue to see kind of propped up real estate prices. The other piece of the real estate analysis that needs to be talked about and paid attention to is there's a very big shortage of U.S. new housing that comes on the market every year. So the numbers that I recently saw were about 200,000 to 250,000 homes is the deficit that we have. So there's basically, here's the demand that we have for new homes in the US, and here's what we actually produce. That deficit or difference is about 200 to 250,000 homes, right? So it's about the size of a city like Miami. That's how many homes more we would have to produce on top of what we already do just to keep up with demand. And so if you continue to have this housing shortage, you've got a lot of kind of margin for error in terms of the demand. So demand could drop, but because there's that housing shortage, you actually could continue to have more demand than supply, and therefore prices at least sustain, if not continue to rise. You have cheap capital at work, right? Again, I'm much more of kind of a macro analysis type person where I want to understand what are the big forces or trends at play so that I don't have to pick the perfect stock. I just have to do asset allocation. And I think that's the key piece that retail misses a lot. I spent a lot of time with institutional investors. And if you ask most of these CIOs that run multi-billion-dollar books, what they'll tell you is the returns that we get doesn't come down to like, did we pick the right stock or not? Or even in many cases, did we pick the right manager or not? It's actually our asset allocation. So did we decide to put 5% or 25% of our assets in commercial real estate? or in private equity or in public equities or in precious metals or whatever it is. That asset allocation is going to be the biggest decision in terms of what returns you actually end up driving. And so that's the part that as a retail investor and individual, you got to back up and look at the whole thing, say, okay, how am I allocating my assets? How much is in public equities versus somewhere else? How much is in real estate? Then once you get into the asset class, do you do low cost indexing? Do you pick stocks? Do you go with a manager? Right? All of those other decisions can help improve or potentially slightly hurt. But there's very few managers that if the public equity market is 15%, there's very few managers that are going to throw up a 2% performance. Or there's very few managers that are going to throw up 40% performance, right? So if the public equities are generally going to be 15% this year, right? Now I'm just making up a number, then most managers are going to oscillate between like 10 and 20%. So you're directionally going to be correct just by the asset allocation decision. And then the micro decision you make can kind of hurt or improve that just a little bit. Same thing with other asset classes as well. And so I think the asset allocation is much more important to look at. Again, I think real estate is super interesting right now, mainly because I see tons and tons of money printing already happening. I think there's going to be trillions of dollars on the way. I do not see this slowing down. And so I think people just got to buckle up, get out of cash, get into these inflation hedge assets, and be prepared to let the structure of the economy and of the financial system and use your knowledge of how money actually works to your advantage so that you're positioned to build wealth rather than try to be a gambler, right? Kind of all the day trading, all that stuff. There's people who are good at it. There's people who get lucky at it. It's not my game. I don't think I have an advantage there. But I do believe that people can definitely benefit in a time of crisis like this if they understand the macro environment. So, all right, that's it for today. I need a huge favor from each one of you. I need you guys to go right now, smash the like button on this video if you learned anything during it so that more people on YouTube see it. Please subscribe to the channel. And then I'm dropping every single morning. I write a letter to over 50,000 investors where I essentially break down business, technology, finance, and Bitcoin. And I do my absolute best to educate people using my personal opinion and my analysis of what's going on in the world. So use pompletter.com. Again, pompletter.com. Go there, sign up. You'll get the email. You'll learn some stuff. You can reply and I read every single one, try my best to respond to everybody. It's awesome. And so I hope you guys enjoy that. Yes, Miss Plina Marinova Pompliano or Plina Ivailova Marinova Pompliano. Thank you for allowing us to do this. I will let her know. Miss Pomp rocks, but she sleeps a lot. That is very, very, very true. All right, that's it for today. Thank you guys so much. Smash the like button, subscribe to the channel, go subscribe at pompletter.com, and I will try to do this again in the future. Thank you guys so much.